If your trading profits are built on an illusion, it's only a matter of time before everything crashes down. And that's the hidden mistake I see even from traders who think they're profitable. You yourself might already be making profits from your trading, but there's always that nagging question in the back of your mind. Is this legit, or am I just on a lucky streak? And that question matters, because if it really is just luck, it can vanish in an instant. But if you know for sure that you've got a genuine edge, it changes everything. You'll handle losses way better. You won't be panicking and tweaking your strategy every time something goes wrong, because you know that your profitability will bounce back. So in this video, I'm going to show you how to confirm once and for all whether you genuinely have an edge or if it's all just an illusion. And if you follow what I'm about to share with you, you'll fundamentally change how you look at every single trade. Not only will this help prove if you do have an edge or not, it will help you to enhance your edge or even set you up to actually develop one in the first place. And by the way, if you're serious about developing your trading edge, you're going to want to check out the free training that I've linked in the description box down below. But more about that later. All right, let's dive in. So, how do most traders try to confirm if they have an edge? They'll usually look at metrics like their profit factor, trader's equation, maybe even just their overall returns. But there's a huge issue here. Those measurements just rely on the results of your trades, the profits and losses. I mean, sure, that sounds logical, like why wouldn't you use P&L data? But let me show you an example to expose why this is so misleading. This is the actual performance of a trading strategy that generated profits of over 140%. That's amazing, right? Steady growth, frequent but small losses. Seems like it's a solid risk profile, nothing too adventurous, and it doesn't look like the account's going to crash and burn. If you plug this into the usual tools, profit factor, Sharpe ratio, you name it, you'd get the green light that this strategy has a real edge. But check this out. Now you're looking at 200 trading strategies that are completely random. No edge at all, basically coin flips. And that awesome performance that I showed you before, it's just this line here, pure luck. Yet most common tools would say, yes, this is a profitable trading system, keep doing what you're doing. And that's dangerous, because since there's no real edge behind that strategy, that same strategy could easily follow a path like this one in the next 200 trades, wiping out all gains. In fact, over a long enough period of time, you'd expect it to fall back to being around break even. So then the question is, how do we fix this? Well, it all comes down to probabilities. Let's clear something up. What exactly is a trading edge? When you open a trade, you're basically making a judgment about probabilities, even if you don't realize it. Like for example, let's say that you're planning a trade on WTI oil. You've got your stop loss below these lows here and a target at the top here. It's a classic 1 to 2 risk to reward setup. If you have no edge, the raw maths says that there's a 33.3% chance for profit and a 66.7% chance for loss. So that's just break even over a large sample, or actually a loss once you factor in transaction costs like the spreads and so on. So we call those probabilities the base rate, the probability of an opportunity if you had no edge at all. But here's the key. If you decide to take that trade, you're implicitly stating that you believe the probability of a profit is higher than the base rate of 33.3%. Otherwise, why would you be taking the trade? So what this means, and I'm going to really oversimplify things just to get the point across, is that having a trading edge doesn't mean being able to choose which opportunities are going to result in a profit. It means being able to estimate the probabilities of a situation differently to the base rate and on average be right. And if you are right on average, you're going to be making money. And if you're not right, you won't. Now, assuming that you are accurate with your probability estimates, the further you are from the base rate, the bigger your edge will be and the more profits you'll be able to reliably make. So that means if you want to know whether you do have an edge and how big that edge is, there are two things you need to measure: how far your estimates are from the base rate and how accurate those estimates are. And if you stay tuned, I'm going to walk you through a step-by-step way to measure exactly that. Just imagine the confidence that you're going to gain when you know that your probabilities line up with reality. That's what I want for you. So let's get into the details. First step, Start making explicit probability estimates for every trade. If you're not quantifying the probability of a profitable outcome, how do you know if you're right or not? So open up a new spreadsheet and log the following columns: trade ID, base rate, your estimated probability divided by base rate, and then the actual outcome. Was it a profit or a loss? So it might look something like this. So the estimated probability divided by base rate, which I'll call the EPBR from now on, that ratio shows us how much further your estimate is compared to the base rate. So for example, if the base rate is 33.3% and you estimate 40%, your EPBR is 1.2. But if you estimated 66.7%, your EPBR is 2. So the higher the number, the more aggressively you think you're beating the base rate probability, which, as I mentioned a moment ago, is one aspect of your edge, if you're right with it. Listen, I know most traders don't use probabilities in their trading, so most people watching this won't be using probabilities. Most trading educators, despite saying trading is a game of probabilities, don't teach about it. Why? Because they are just making things up as they go along. They don't really have any real depth of knowledge or experience, but that's a whole discussion for another time. So if you're not sure where to start with all of this, check out the free training that's in the description box down below. So in that training, I'll start teaching you exactly what you need to know, and I'll even follow up with more free training afterwards. So it's a real no-brainer. Go and check it out, the link is down below. Now, something that you might have been thinking about is that each individual trade only has one outcome. It's not like it ends up being a 60% profit and a 40% loss, and therefore your probability estimate was exactly right. It's only one outcome. So we can't directly say whether your exact probability estimate was spot on for each individual trade. But here's the trick. If we analyze groups of trades, we can see how accurate you are on average. Now, I have to give a massive shout out here to a member of our community, Kento Aikida. He helped us to refine our original process for these next steps that I'm going to walk you through, and he helped us to make them a lot better. Now, this guy is so switched on when it comes to the data side of trading, and he also helps out other members of our community with their data and finding these optimizations and insights. And that's really the benefit of having an amazing community with really smart people. Everyone can learn and level up. So here are the next steps that you need to follow. You're going to group your trades together based on the EPBR ratio, which means we're grouping them based on how aggressive our estimates were. And you can group them in other ways as well, which we'll talk about in just a moment. Now we can open a new tab in the spreadsheet and add the following columns: the label for the group, in this case it'll be the EPBR, the mean average of the base rate for that group, the mean average of the estimated probabilities, the actual result, percentage profitable that is, so we want that as a percentage, the sample size, the mean EPBR, then the actual results divided by the mean base rate. We can then take this data and plot it onto a chart so that we can analyze our performance. So we're going to plot the mean EPBR and the actual result divided by the mean base rate. And you can see we've added the dotted line at 1. This is break even, which means anything above this is profitable and anything below it is losing. If the actual result divided by mean base rate is above 1, that's good. It means you're profiting. However, just like we discussed earlier in the video, that could be just pure luck. You know, that amazing performance that I showed you from the completely random trading strategy would also be above 1 overall, but it had no edge. So here's where things get fun. Your EPBR line is what you expected before entering the trade. And the closer the actual result line is to this EPBR line, the more accurate your estimates were. Let's put this into perspective. If your results were profitable for a group of trades, you'd expect that that data point for this line would be above 1. But if your EPBR line is very far from that, it means that although you were profitable, your estimates and reality were not aligned. So there's a chance that the profits may have been luck. At best, we can say that you do have an edge, but the profits are unreliable and you can't depend on your performance in future. On the other hand, if the estimates and reality are very close, it means your estimates are much more accurate. There's something that you're reading in the market that allows you to accurately predict what may happen next. That means your profits are less likely to be luck and are going to be more reliable because they're an accurate reflection of what you anticipated. Whatever you're analysing in the markets is clearly meaningful. But no one is ever going to be perfectly accurate with this. There will always be ways to improve, whether that's because you're currently below base rates, you're losing, or you're above base rate but inaccurate, so you want to refine the skill to make sure you're not trading just based on luck. And this is where grouping the data in different ways can help you reveal insights about which areas you need to work on a bit more. At the moment we're grouping the data based on the EPBR. That means that we're seeing how we perform depending on how ambitious our estimates are. So for example, it might be the case for you that the higher the EPBR ratio, where you're further from the base rate, the more overconfident you are. And that might mean that in future you can just recalibrate, because when there's a higher EPBR for an opportunity, you just adjust your estimated probability down a touch, and that's how you recalibrate then. But really, this is the fun bit, where you get to really dig deeper into different ways of categorizing your trades to find those insights. Like for example, what if you group the trades based on different market conditions, different setup types, different aspects of your analysis, different times of day or days of the week? The possibilities are endless, and each layer of insight helps you to refine your approach. You can cut out losing scenarios, refine what's working. You might even realize that your whole trading approach is just entirely meaningless and you've just been trading based on luck. Now, that's a bitter pill to swallow, but it's always better to find that out rather than just continuing with your head buried in the sand, not knowing whether it's luck or not. So this video is getting on a bit and you can see it's getting quite dark in here. So let's start wrapping things up. Hopefully now you can see how important this data can be and how the data that you're currently tracking probably isn't helping you to improve in specific ways. Most measures don't tell you specifically what's working or what to change. They're usually just vanity metrics. But using probabilities to analyze your performance will show you exactly where things stand, so you can make logical changes much more intelligently. All right, so a couple of things. Firstly, if you found this helpful, hit the thumbs up button, drop a comment down below, and share this with another trader that you know. Let's help more people wake up to the fact that luck is not a strategy. There are so many traders out there who need this training, and in fact, many trading mentors and gurus probably need it the most. So be the good guy and share it with them as well. Next, check out the link in the description for my free training that I mentioned earlier that will get you on the right track with all of this and start using a meaningful trading approach that isn't just based on luck. If you're stuck using outdated methods that the industry just keeps trying to shove down your throat, this training will open your eyes and save you loads of time and frustration. And finally, remember, all of this probability data is only meaningful if you've got enough trades in your sample. If one of the groups that you're analyzing only has a small number of trades, you can't come to a reliable conclusion about it. So on screen now, you'll see two videos. One shows you exactly how large your sample size needs to be, and we talk about that. And the other is a trading simulator guide that will help you gather reliable data much quicker. So go and watch those now, because once you've got enough trades under your belt and you're analyzing them in the right way, you'll never have to second guess if your profits are real or just a lucky streak. And then you can optimize your way to success. So I'll see you in one of those videos in a second, but until then, trade logically and let's keep building your edge.